Hawk Taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Tax Lady, and this is tax season, and we want to help you. So if you're sitting there wondering about what's deductible, can you deduct Aunt Sally who's been living in the house? How about your kids? They're going to college. Should you take the credit? Should they take the credit? We want to help. Our phone number is 803-0930, 803-0930, star 930 on a cell phone, and I have Christopher Fabian with me. Hey, Chris.
Hello, Esther.
Out of the office? Boy,
yes.
Oh, boy.
Yeah, thanks. You picked the cold day for me.
Hey, look it. It's been like warm and balmy here. Right?
I know. I'm not
warm
complaining.
And balmy. There's been
I'm not complaining.
Green grass, and so we got a 5-day winter.
That's
I can
right.
stand a
That's
5-day
right.
winter.
Yep.
Anyway, I'm Esther Gulius, the tax lady from EG Tax. All of our offices are open tonight till 9. We're open 9 to 9 Monday through Friday. We want to help you. You can ask tax questions. If you can't get through to the IRS, you can go to our website at egtax.com. We want to help you, right?
That's right. That's
So-
right. We love helping.
We do. 803-0930, 803-0930, star 930 on a cell phone. Whether you're listening to us on WGUF in Florida or you're watching us on TV on WBBZ Tuesday nights at 6:30, or you're listening to us on WBEN, we certainly want to help. I'm Esther Gulius, the tax lady. We have 30 area offices here in Western New York, in Florida, Arizona. We want to help.
That's right. Yep.
Today we have a topic. We usually have a topic every time we have a radio show, TV show, and today we're talking about gifting, because people probably call and ask questions about gifting and houses and selling houses, and if mom gives me the house, and what do I do with this, and the look back and whatever. And today we hope we're going to take some of the mystery out of gifting, right?
That's right. That's right.
So to me, the thing is you have to first say, what's my goal? Why would people want to give gifts of money?
Well, normally it's to avoid the nursing home taking it. You know, bring down your asset. Well, that's number one, to avoid the nursing home. Number two is to reduce your required minimum distribution later on.
Right. So that, or maybe you just love your kids or your grandkids. You want to give them money. So first of all, you can either here's the thing. You can gift away pretty much your entire estate in one fell swoop. Boom. The only thing is you have to do a gift tax return. Right.
Yep.
So the person giving the assets to the people that are going to receive it, if they give more than $14,000 per person per year, they have to do a gift tax return. Right?
Right.
And the unified exclusion is 5.43, based on $5.43 million in assets. So if you have less than $5.43 million in assets, pretty much you're never going to pay an estate tax, and so that's what the gift tax is doing.
Right. And how much money would they owe on that gift tax return?
Nothing.
Absolutely
So,
nothing.
so let's say you're somebody that's listening, or you're watching on Channel 5 in Buffalo, and you say, gee, here I am, I'm 72 years old. I would really like to start gifting away some of my assets, either in preparation of death or for nursing home vulnerability. And I have $300,000. You can gift it all away right now.
Yep.
You do have to do a gift tax return. It is going to adjust your unified exclusion. But if you're never going to have an estate worth more than $5.43 million, you don't have a problem.
That's right. Yep.
Right?
And how many people? I can only give up to $14,000, right? Right? No, you can give as much as you want, and they don't comprehend. They just
Right. I mean, you don't have to do a gift tax return if you give less than $14,000 per person per year. That's the only thing you're saving, is doing that simple little gift tax return, right?
Yes.
So I wanted to clear that up for people. And the other thing is they have problems with gifting their house and their estate. And what if mom gave me the house? Or what if it was in a life estate? And we're going to talk about that too. I'm Esther Gulius, the tax lady, 803-0930. 803-0930, star 930 on a cell phone. Our toll-free number is 1-800-616-9236, whether you're in Toronto. Maybe you're in Toronto and you heard that maybe you have to do an FBAR report. We can help you with that, too.
That's right. That's right. Lovely FBAR, the foreign bank account reconciliation.
That's right. And we're not swearing at you either.
No.
So let's go to the phones. We're going to talk to Mike. Hi, Mike.
Hi. My question is, does everyone who files a tax return this year need to have a 1095-C, which shows that you had insurance, even if you're retired and you're not working?
All right, Chris, you can answer that.
Yeah, there's 3 different 1095s out there now. A 1095-A, which means you have insurance through the marketplace. A 1095-B, which is insurance through the government, through either Medicare, the VA, and then the 1095-C, meaning you have insurance through the employer, through your employer. There's no place on the 1040 where you have to enter information on that. It's just to prove that you have health insurance. So if you're waiting for that to come in, you don't need to.
That's exactly right.
You just, yes, I have health insurance. On the basic form, it's just a checkbox that you have health insurance.
Right. Oh, it's just a checkbox.
Yep.
Now it gets far more complicated if you are somebody that had a subsidy and you had gotten it through the marketplace, because then you have to reconcile the subsidy you got with your actual income. And so then there are new forms to fill out. And that 1095-C is the form that would let you know that you got a subsidy, how much the subsidy
that's an
is.
A.
1095A is the one that's going to tell you how much you got in subsidies and how much was the minimum insurance, and that's where you have to do the reconciliation. But if you're somebody that has full health insurance, either through the government, whether it be Medicaid, VA, or through your employer, you don't have to even worry about it. Just check that box. Yes, I have full health insurance.
What about Medicare? If you're on Medicare, are you
Same thing.
Same thing.
Yep.
Will they send you a form or?
No.
Yeah, they'll mail you a form, but you don't need it to do your taxes.
Right.
Okay, because we usually get our taxes at EG Tax, and so when we go in, we don't.
Mike, you don't have to worry. Honest, because if you go into our office, we're going to have you fill out a form that says yes, I had full health insurance, and so when you give that form to the preparer, what they're going to do is we have an internal form we fill out that says yes, this taxpayer had full insurance, and you don't need the form.
Because our daughter turned 26 last summer, okay, and she was under our insurance till August or September, I think.
Right.
And then she got insurance through the new company,
right,
not till December. Now there's a.
All right. Now you see, but that's okay. But you don't claim your daughter as a dependent anymore.
No.
Okay. When she files her return, she's going to have to reconcile the fact that she didn't have full insurance. And so she's going to have to apply for an exception if she can.
Well, actually, she didn't have it September, October, November, so that's 3 months.
3 months.
So she's automatically
accepted. Right.
So is there a grace period like between the?
There's a 3-month grace period.
3 months grace period, right.
Okay, then thank you.
You're welcome. Thank you. I'm Esther Golias, the tax lady from EG Tax. Give us a call here in studio, 803-0930, 803-0930, star 930 on a cell phone. I know we have Jack, Alan, Joe, and your calls up on deck, and we're going to take a short break. We'll see you in a minute.
Let me tell you how it will be. There's one for you,
19 for me. Hey, I'm Esther Golias, the tax lady, and we want to help you with your taxes, and we want to give you little angles that maybe you haven't thought of. I will tell you, I had a client that came in today. She's been doing her own returns, and she didn't know that there was something that was called non-qualified income if you're filing an earned income credit. And this particular lady qualified. She had income of $22,000. She has a dependent child. She made herself single rather than had a household. But she has rental. She has part of her house rented out. and she came down to zero income, so she really didn't try hard to get her expenses down
Right.
on her Schedule E. What that meant that she ended up with like $3,800 worth of rental income,
Uh-oh.
which means that she can't get the earned income credit because she made more than $3,400, and she had been doing that for like 4 or 5 years. So I'm amending all the returns I can, and I'm getting her back about $9,000. But that's what the heartbreak is. If you don't know the innuendos of the law, you can be missing something. So that's part of what we want to help you to do, right?
Definitely.
Okay. And by the way, I wanted to make sure that when we were talking about gifting at the beginning of the show, is that there is a 5-year look back in New York State. So if you're somebody that's anticipating gifting away your assets in anticipation of protection of nursing home, so you can go on Medicaid. Then you have to take into consideration the 5-year look back. So I just wanted to bring that up too. Okay. Let's go to the phones, and we're going to go to Jack. Hey, Jack, how can we help you?
Hi, yes. I was just appointed as administrator of an unclaimed funds account.
Okay.
Is that taxable now?
Yes, sir.
That is taxable, even if it's 2 insurance policies?
Well, the unclaimed funds, if it's like a MetLife policy,
I'm talking about
Prudential, then, all right, it's potentially taxable. In other words, the person who had gifted it to you or inherited it to you, if it came through the estate and they just didn't know where to find you, and then the state of New York cashed it in, then it would be a stepped-up basis. Right, Chris?
Right. And then it would be the interest you would pay tax on from the time that it's been cashed in,
right,
or surrendered when it should have been, to the time you get it. All that interest you would have to claim on your tax return.
Right.
Is there a special form in that there, I guess?
You're going to have to do a Schedule D if it's the sale of stock in Prudential. So
I don't think so. This was the 1930s.
Okay, but
I mean,
this was unclaimed funds that you got through New York State, right?
Well, I haven't got it yet. Okay.
Okay, but generally it's unclaimed funds from New York State due to a demutualization. That's what I'm reading into this. I may be reading the tea leaves wrong. But what I'd suggest you do, Jack, is if you want to fax us over or bring to the office the form that the state's going to get you, if it's due to demutualization and it was inherited, then there'd be a stepped-up basis in the stock. If it was just cashing in an annuity, it could be or may or may not be taxable, but it sounds like it, but it definitely potentially is taxable.
Okay, there's one more question I'd like to ask you.
Yeah.
Okay, if I do get this check and that there, is it wise I put this check into a checking account?
It doesn't matter. It doesn't matter.
I mean, it's your money, Jack. Whatever you want, you can put it in your mattress. You can put it in your
Not
pillow.
my money. I have 5 other people involved.
Okay, so you inherited the money, and now you're going to split it between the heirs.
Yes, I am on one side. My brother passed away. He's got 5 heirs.
All right, not each one hasn't been notified by the state. It all came to you.
They do notify. They have been notified. I did send it into surrogate's court. Okay, I got appointed as administrator. They have all the information. Now the state of New York wants a state hold harmless form.
Mm-hmm.
Okay, and I haven't. They got. And I do have an estate.
Okay, all right. So I'm getting the drift of it. What you want to do is you want to set up a bank account so that if this money is all being given to you individually, and you're going to have to split it up with the heirs, you really should set up a trust account.
Right.
Right. So,
Okay.
and if you you would need to get an EIN number for the estate if that's what you're doing.
I do have an EIN number right here.
All right, then set up a trust account, put the money in the trust account, and you're going to have to do a fiduciary return. This is what it sounds like now, and you'll have to split up, give each of the heirs through the trust as and the estate as you're handling the affairs.
Right. So then once with the trust, you'll do a K1. So
And
then
split
each
everything
of the
up.
6 people will be claiming a little bit of
Right.
the income.
Right.
Well, it looks like I'll probably be seeing you.
Yeah. Well, I mean, us or whoever, Jack, but you certainly don't want to walk unguided through this. Okay.
Right. Also,
Okay.
one more question you could
Yeah.
answer us?
Well, actually, Jack, I got a lot of phone calls here. I
Okay.
gotta take. I would suggest you call us at our corporate office at 632-7886, and you can talk to us. There's always a tax expert there that can help you. But it sounds like you're really dealing with an estate. You're going to have to do a trust account, put the money in the trust account, go through probate, and then allocate it through the 1041. Okay?
Okay, fine. Thank you very much
sir.
for the info.
All right, thank you. I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. And we're going to go to Alan. Hi, Alan. How can we help you?
Back to your gift tax.
Yeah.
I took out a home equity line of credit, and
Okay.
I wrote a check to two of my children to purchase a house
Okay.
out of that account.
Okay.
Do I still need to fill out a gift tax form?
Okay. Did you give it to them or loan it to them?
I gave it to them.
Then?
Yep. How much did you give to them?
$20,000 to one and $50,000 to another.
Okay, so it's over. That's over
the
14. And so did you give 14 and your wife gave part of it?
Well, it's a joint home equity line of credit.
So your wife
it's not-
gave part and you gave part, right?
Sure.
So on the one that you gave 20 to,
There's
then
nothing to do.
it might have been 10 from her and 10 from you, so that eliminates them. But on the one you gave 50 to, there would be 14 for her, 14 for you. That's 28, and you're going to have to do a gift tax return on that one.
Unless, was she married?
Yes, they're both married.
All right,
And did you
so-
write a check payable to Mr. and Mrs.?
I believe it was written to my daughter and not my
Yeah.
son.
Okay.
So then-
and that's something people want to think about too. So if they want to stick to that $14,000 rule, 14,000 from you, 14,000 from your spouse, to the husband, to the wife. So now you've really doubled it. So it's 56.
Right. But in his situation, he's
It
going
isn't.
to have to
You're
do
gonna have to
the
do
gift
it.
tax.
But it's not a hard form, and it's just
no
to
worries
keep
about
track
it.
of the
Do they
unified
have to pay tax
exclusion.
on that gift?
What was that? I'm sorry?
Do they pay the tax?
No, no one
it's
pays tax.
It's tax free to them, tax free to you, except you got to do the gift tax return
Okay.
if it's over 14. Okay?
Thank you so much.
Thanks, sir. Thanks for listening. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and toll free, 1-800-616-9236. Okay, before we get to the other phone calls, gifting houses. What
Yep.
seems to be a very popular thing is that moms and dads put the kids on the title, right?
Right.
Now, if mom and dad just strictly put the kid's name on the title and gift the house to them, then with the notion that they want to protect the asset from nursing home, right?
Yep.
What happens when the kids sell the house?
They're in for trouble, depending when mom and dad bought the house. But their basis goes back to mom and dad's basis. So it's the original purchase price plus all the improvements that was done. A new roof, remodeling the bathroom, the kitchen, maybe a new driveway. All that gets added up into it. So they may end up paying tax on a lot of money.
The kids.
The kids.
Because
yes.
they got it prior to mom and dad's death,
inheritance,
and they didn't inherit it. They don't get a stepped-up basis because they didn't inherit it. So think about this: mom and dad bought it for 20, put maybe 30,000 of improvements. So now we got $50,000 cost basis. Kids sell it for 200,000. There's $150,000 gain, right?
Right.
And I will tell you, if you are going to gift your house to your children, sit down and write out all the costs and all the things that you put into the house now, because when we all go, nobody knows what you paid for
That's right.
everything.
That's
and
right.
save the receipts. Now, if the kids inherit the house,
Totally
then it's a
different
completely
story.
horse of a different color.
Yep,
right?
because then they get a stepped-up basis, what the house was worth when the last parent passed away. So if their basis was 20, but the house is worth 100 now, and they died, and the children inherited it, their basis is the 100. They sell it for 100.
No,
It's a wash,
not taxable.
no income.
So that's another thing you really have to think about. Just marching down to get your name off the deed, to put the kid's name on the deed, may help it in a nursing home situation if that 5-year look back thing doesn't happen, but can cost taxes when you're gone.
Yep.
Right? Okay, let's go back to the phones, and we have Joe. Hi, Joe. How can we help you?
Yeah, I have a question about alternative minimum tax. When does one have to file or exercise the paperwork to doing alternative minimum tax?
Okay, when your income, when you have alternative minimum tax income, and I don't even know if I have
Are
it
you
right
single
here.
or married?
I'm married.
Okay. Do you have a lot of write-offs?
Well, that's the other question. Do you have to itemize to do it, or
No, it can be it can be standard deduction too.
It all depends on like how many children you have. There's a lot of different.
And they're all gone.
Yeah. So, are you just a basic standard? Like you have no, you're not a self-employed or have money in the stock market.
Retired, right?
Retired. Okay. I would say really for you there would be no AMT. And I think it's around 80,000.
I'm looking it up.
Esther's looking it up right now just to be sure, but I'm thinking it's around 85,000 because I know they just 2 years ago passed it with inflation, so we don't have to worry about them bringing it back to 1958.
Is it 85,000 AGI?
Yep. Hold on 1 second. Esther's getting that figure.
18. Let's see. AMT.
Hold on. I know we're making great radio right now.
Let's see. The exemption is 83.4, married filing a joint return. Single is 53.6, and married filing separate is 41.7.
So if your AGI is 83, married filing jointly, you have to go through the exercise to...
Well, that would be the exclusion. So anything over that, you could potentially have alternative minimum tax income. So you would take your taxable income, add all your subtractions to it, pretty much, and you come up with an alternative minimum tax income. If it's under that 83.6 figure, you don't have to worry about it.
And what IRS form is that?
6251.
6251.
Okay.
Well, thank you very much.
All right, thank you, sir. Because alternative minimum tax is an alternative way to do your tax computation, adding back all your deductions, credits, your exemptions, because they want to make sure that you're not getting away scot-free, and they make you recompute your tax liability using the higher figure, right?
That's right, because they want their money.
They want their money. All right. I'm Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. We're going to take a short break for news, and we'll see you on the other side.
Let me tell you how it will be.
Taxman. Hey, I'm Esther Gullius, the tax lady from EG Tax. We want to help you with your taxes. Give us a call at 803-0930, 803-0930, star 930 on a cell phone. We have had Paul waiting for such a long time. Hey, Paul, I'm so sorry to make you wait. How can we help you?
Hi, Esther. How are you?
Good. What can we do for you?
Well, as I'm listening to your show today, I come home and I open my mailbox and I have a letter from the IRS telling me about we received a federal income tax return form 1040 with your name and social security number.
Oh, identity
theft. To protect
theft.
you from identity theft, we need to verify your identity before we process the return.
Did you do your return yet?
I have not.
Oh, you're a victim of identity theft. Okay, so you really want to make sure you contact the Internal Revenue Service so that they're going to give you a special PIN number, so when you file your return, they'll know it's you.
And there's like a form, I believe it's a 14310, off the top of my head, I may be off just a little, that you have to fill out to say that it was identity theft.
Right. So I guess I would not file my return until after I talk to them, because they already have a tax return filed by somebody pretending to be you who is trying to get a refund, and so you want to make sure that you talk to them and find and get pointers from them, so that when you file your return with that special code, they'll know it's you, and then they won't hold up your refund.
Okay. This wouldn't have anything to do with a spouse. Maybe she filed separate.
No, it should not. I mean, it should. The truth is, somebody used your Social Security number on a tax return. Now, if you have an estranged situation and somebody was not very smart and they filed a joint return in your honor, that's a possibility. But you won't know until you talk to them.
Okay, I will get in touch with them.
All right, thank you, Paul. If you need help, give us a call.
All right. Bye.
Thank you, sir.
That's
so sad. Isn't it?
It is. Identity theft is huge with tax returns. You got to be very careful. I know states are being proactive and trying to get people to put their license numbers down and issue estates on tax returns to try to prevent it. But also the telephone fraud scams.
Oh my
going
gosh!
on.
Our telephone people said that yesterday. People were calling, crying, saying the Internal Revenue Service just called and said that you have to go right now and get a Walmart gift card with $3,000 on it and send it to us. It's not true. That isn't happening. I mean, it's happening.
Fraud.
That's fraud.
Yep.
And so don't go and pay anybody. Anybody that calls you that says they're from the Internal Revenue Service. If they really are from the Internal Revenue Service, it would have to be on an outstanding liability that you already had.
That you knew about.
Right, that you knew about. And they won't ask for money. You don't have to send money. They're going to ask you to pay the IRS, but they're not going to say, go and get a gift card or you have to give us money right now. So if you're in doubt, you can call EG Tax and we'll be very happy to help you. But the people calling saying you have to come up with money right now, it's all fraud.
Yep. Tell them you'll put on a pot of coffee and come on over.
Right. I had a client yesterday said, "Oh, great! I'm so glad you're on the phone. I'm a police officer and I'm recording this call." Click.
Yep.
I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Love to hear what you have to say. Love to hear if you have any tax questions. Well, give us a call. All of our offices are open tonight till 9 o'clock, next week 9 to 9, and then starting next Saturday to be 9 to 5, right,
Just
Chris?
for Saturdays,
All
9
right,
to 5.
let's go to the phones and talk to Rose. Hey, Rose, how can we help you?
Hi, I'm one of those people that turned over my house to my kids quite a few years ago.
Okay.
And I'm wondering how I can correct that now.
Okay.
I don't want them to have to pay that tax.
All right, so literally, Rose, you signed over the title. You didn't do a life estate. You put them on the title and you took yourself off. Okay. Well, the first thing you can do is you can switch the title back if you wanted. If you wanted to give the house back to you. Are you looking to live in the house for the rest of your life?
The house.
Have you looked into a life estate?
I don't know what that is.
Well, what I'd suggest you do is contact your attorney, and the kids can gift back the house back to you, and then she can do a life estate.
Right. Yep.
And so that means that you get to live in the house forever and ever, as long as you want to. But what happens is the children don't retain ownership until after. I mean, don't get ownership until after the estate is settled, and so they'll get a stepped-up basis on the property, and that'll eliminate the whole taxability issue.
Oh, I think maybe I do have that, because when my tax bill comes in, it has LU on it.
LU? You mean LE?
I think that's a life.
You mean LE?
No, I think it's...
Well, anyway, I'm going to tell you what you should do.
Sure.
You should check with your attorney.
Yep.
Okay. All right. Thank you so much.
Thanks, Rose.
All right.
Have a good day. I'm Esther Golias, the tax lady from EG Tax. If you need great tax help, all of our offices are able to help you with most anything tax related. If you have questions, we answer questions. If you need your questions answered online, you can go to egtax.com. And our prices are pretty much half price of what everybody else charges, and we absolutely guarantee everything, and we love you and want to help you. Our phone number here in studio is 8030930, 8030930, star 930 on a cell phone. And until this is our time to kind of bow out with our viewers on WBBZ, and until next week, we'll see you on Channel 5. But the rest of you, we're going to take a short break, and we'll be right back.